In small, medium business valuation, okay, just remember price equals return divided by risk, right? I'm going to say it again and again, okay?
Yeah.
If you're a public analyst, okay, you should, a public analyst, which is 99% of all of us, we spend most of our time assessing risk, okay? The bottom part of the equation. You know why we do that? It's because how are public executives compensated? Okay.
Hmm.
Well, they make, let's say the executive makes $1 million salary. Pretty good. But they get $20 million in stock options. Okay. So let's go back here. If this is a public company, okay, one, if you want to sell your stock to the public, okay, you got to get audited financials. You have to report a cash flow statement, right? And the incentive of the public company is to show as much money as they possibly can in earnings. Why? So that their stock price goes up, so they get compensated more. Does that make sense?
Yeah.
That's on the public side. The private side, okay, they don't have to report this to anybody except to the IRS. And what's the company focus in a private company? To lower taxes as much as they can, right?
Right.
Because they don't, nobody's buying shares of stock from them. Does that make sense too? Okay. And so here's a mega tip for you guys out there. Okay. A lot of analysts still, they spend all their time worrying about the risk. What you need to spend most of your time on is focusing on the return, making sure that you understand how the sales and expenses are running through the company and how much true cash flow is there. Okay. So here are the problems that you had when you're trying to measure the earnings of a private business. Because right here, I just gave you the formula. Okay. But here it goes back into modeling science versus modeling economics, right? How do you know that the accounting was done properly? See, the problem is when we're looking at small businesses, we can't be sure that their QuickBooks printout was printed out like the right way. Does that make sense?
Yeah.
And they have a lot of leeway in terms of gap how they put their financials together. So that creates a little problem. So you have to really, if you're putting garbage in, you're going to get garbage out, right? So if your numbers are off here, your free cash flow number is going to be off, and you're making millions of dollars of decisions based on a formula that you think is correct, but your underlying theory and the underlying numbers that you're using are incorrect. See the danger in there, right?
Yeah.
So let's talk about, I'm going to jump down to C just while I'm on there. What about fixing the balance sheet? Okay, that's a difficult class. I would need to do a class in terms of trying to fix the balance sheet because the income statement is easier to fix, right? We're going to talk about that in a sec. And then the cash flow statement. How often are you getting a cash flow statement from the sellers? I don't know, 10%, 20%, depends how big the business is. The bigger the business you get, the more likely you are to get a cash flow statement. The smaller the business, the least likely you are to get a cash flow statement. In fact, when you get a lot of stuff from brokers, they just might have an income statement. Is that true?
Yeah.
They didn't even bring all this other analysis in there. So you really have two options. You got to get that and you have to build this yourself, okay, which is what I
Mm.
have to do sometimes.
So the
So
cash
you
flow
have to
statement is separate from the income statement, right?
correct, right? So
Mm.
there's three main statements that everybody, and especially in a public company, has:
Yeah.
balance sheet, income statement, and cash flow statement. The only way you can create this cash flow statement is if you have a balance sheet and you have an income statement.
Mm.
Okay, and you need the balance sheet for at least 2 years because you're making adjustments here on the cash flow. You're showing the changes. Okay,
Right.
so when I'm always now, let's talk about actual deal flow. Now, I'm a financial analyst, but I've closed a lot of deals and still do own many businesses myself. Okay, so when I'm working with a seller that I talk to and there's no broker involved, okay, I'm very careful how I massage to get the numbers, right? My strategy is always I like to get to know the guy. I tell him what a great business it is. You know, he sells me whatever, and I'm like, oh, this is awesome. This is awesome. I never bring it up until I feel it's the right moment, and I always go, sir, you know, I think this is really, really awesome. Excited. I'd love to do this. I just would need to see some financials to, you know, make an offer and actually buy the business from you. And at that point, you see, I'm trying to massage it in. If I'm dealing with a broker, okay, the broker's whole job is to get me documents. Okay, so I'll put these guys to work. And I'm like, hey, I need balance sheets, I need income statements, I need everything you can get. Okay, give me the tax returns, give me all this, because I want them to work to get me all these things so I can create this and make good estimates. You see what I'm saying?
Yeah.
So it can take you longer when you're working your way in to get the statements from the buyer, but just for us, you know, your goal is to eventually get here so you can analyze the unlevered cash, right? You're trying to get to that free cash so you can be like Warren Buffett said and do like Dan said, right? So let me jump back here. Okay, so one of the things that, like I said, we're spending our time focusing on the return, because what happens in small businesses, you got to do your add backs, right? So one-time fees. There may be a rent adjustment. There could be an owner salary adjustment. Owner expenses on the income statement. You know, what are the classics? Auto. Let me tell you a crazy story. I was representing a girl who was buying a home health company. Okay, and the home health company did about $2.5 million in sales a year. Okay? And I think they probably had 60 workers. So it was a good company, right? Do you know what they reported on their income statement? $40,000. Okay. So $2.5 million in sales, and they said they made 40,000. Okay. So the husband, there was two women that were the wife. The one wife owned the business, and I was representing a lady who was the nurse. So it was like two females who were like the bosses, and two guys, her husband and me, who are the analyst. Okay. And her husband's a CPA. Okay. They tried to add back a $60,000 vacation to Dubai. $60,000 vacation to Dubai. They were trying to add back. They wanted almost $425,000 in add backs. I was like, basically, you're committing fraud. I mean, they were renovating their kitchens, and I mean, it was unbelievable, and I couldn't believe the guy was a licensed CPA, right? You know what I'm saying? He just knew he wasn't going to get audited, right? But then he try to add all these add backs. So we have to spend time on really making sure we do these add backs. Now, here's my rule of thumb, okay? So I want you to think about this equation here. If there are a lot of add backs, okay, I may count them, but what am I going to do right here? I'm going to increase the risk. Does that make sense? So if the owner is reporting all of this income to the bottom line and paying the tax on it, my risk goes lower. That's not real money. Okay? Because you remember, I'm measuring the return, and then I'm measuring the risk, right? So a good broker or investment banker. So when I'm selling a business, where I'm consulting a business, I will do all this exercise for the buyer, because I don't want to hide anything. I want to show them the money, right? So let's take a look at one. But the key thing is, like I said, you got to think logical. Okay.